Right now, somewhere in Dubai, a software consultant is having coffee overlooking the Burj Khalifa. Last year, she earned $210,000. Her tax bill on that income, once you strip out the exclusions she's built her life around, was close to zero. Not an error, not an audit waiting to happen, a designed outcome built on public, verifiable law anyone could set up within 12 months. Meanwhile, most people are doing the opposite. Same city they were born in, same job their parents had, same government taxing the same worldwide income, never asking if the map they inherited is the only map available. It isn't. It was never a law of physics. It's a set of choices nobody told them they had. Welcome to Wealth Forge, first video or 50th. I'm Dr. Ben, and today we're taking apart the Billionaire Nomad Strategy. Real countries, real numbers, real legal structures, showing how the wealthiest, most mobile people on Earth decoupled their income from their address, and why that's now within reach of an ordinary professional. Before the mechanics, one idea to hold on to, because it reframes everything else here. We don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom. Say that back to yourself later tonight, because everything I'm about to walk you through is really just one long, practical demonstration of that sentence. Here's the uncomfortable truth most financial content creators won't say out loud. The default plan, work locally, get taxed locally, retire locally, isn't neutral. It's not just how things are. It's a system that was built for a world where labor was physically anchored to one office, one factory, one region. That world is mostly gone. Income today is digital, portable, and increasingly indifferent to which country you're sitting in when you generate it. But the tax architecture most people operate under was written for the old anchored world. Followers keep living inside a blueprint that no longer matches how they actually work. Architects redraw the blueprint. If that lands a little uncomfortable, good. It's supposed to. The question isn't whether you notice the gap, it's which side of it you've been standing on. So let's redraw it. There are 3 structural layers to this strategy, and almost every case study you've seen online about someone paying zero legally is really just some combination of these 3 layers stacked correctly. Layer 1 is jurisdictional selection. This is choosing where your tax residency actually sits, as opposed to where you happen to sleep on a given Tuesday. As of this year, there are roughly 16 to 17 countries in the world that impose no personal income tax at all. Some of them you already know: the United Arab Emirates, Monaco, the Bahamas, the Cayman Islands. Others get less attention: Bahrain, Qatar, Kuwait, Vanuatu, Bermuda, St. Kitts and Nevis, Antigua and Barbuda, the British Virgin Islands, the Turks and Caicos Islands. None of these countries are broke. They fund themselves through oil revenue, tourism receipts, licensing fees, value-added tax, or, in the case of somewhere like the Cayman Islands, an entire economy built around being the back office of global finance. Zero income tax doesn't mean zero government. It means government that chose a different revenue model and structured its immigration policy to attract the kind of people and capital that make that model work. Take the UAE specifically, because it's the cleanest modern example. Personal income in the UAE is not taxed at all. What the UAE does tax is corporate profit at 9%, but only on profits above roughly 375,000 AED, which today is a little over 100,000 US dollars. There's also a 5% value-added tax on most goods and services. So the honest picture isn't the UAE has no taxes, it's the UAE has restructured which activities get taxed, and personal salary income isn't one of them. That distinction matters because it tells you the strategy isn't about hiding from taxation. It's about positioning your income to land in the category that jurisdiction has chosen not to tax.
Getting the residency itself typically runs through the UAE's Golden Visa program, a long-term renewable residency generally tied to a real estate investment of around 2 million dirhams, roughly 550,000 US dollars, which is a meaningfully lower bar of entry than either Monaco or the Cayman Islands, and one reason the UAE has become the most talked about zero-tax destination of the last several years, rather than a quiet, long-standing option like the other two. Monaco works differently and is worth understanding even if it's out of reach for most people watching. Residents pay no income tax, full stop, with one narrow exception for French citizens under a specific treaty. But Monaco isn't cheap to access. You generally need to demonstrate substantial financial resources, deposit around €500,000 with a Monegasque bank, and secure housing, and you need to actually spend time there, generally around 183 days a year, to maintain the benefit. Monaco is a preservation play for people who've already built the fortune. It is not usually the entry point. The Cayman Islands sit somewhere in between. No income tax, no capital gains tax, no inheritance tax, and a legal and financial infrastructure built specifically for global investors and fund managers. Long-term residency there typically runs through an investment of well over $1 million in real estate or local business. So again, this is a structure for people who've already accumulated meaningfully, not a first move for someone just starting to build. So go back to that consultant on the terrace in Dubai. She isn't hiding from anyone. She's simply sitting inside a country that made a deliberate choice not to tax her income category. And now you know exactly which choice that was. Now, here's where it gets interesting for the person watching this who isn't yet a millionaire, because layer 2 of the strategy is digital nomad and remote work residency, and this layer has exploded in the last 5 years in a way that almost nobody talks about with any precision. Estonia issued the first world's dedicated digital nomad visa back in 2020. Today, more than 60 countries run some version of that program. Portugal, Spain, Greece, Croatia, Malta, Cyprus, Georgia, Costa Rica, Mexico, Colombia, even the UAE itself, all offer a legal pathway for someone earning income from clients or an employer outside the country to live there openly for a year or more, often with a renewal path into longer-term residency. This is not a legal gray zone. It is not working quietly on a tourist visa and hoping nobody asks questions. It is a government-issued, purpose-built visa category that assumes you'll be exactly what you are, a person whose income has no fixed address. The requirements vary enormously, and this matters because digital nomad visa is not one product, it's 60 different products. Colombia asks for proof of around $750 in income. Portugal's D8 visa is pegged to 4 times the local minimum wage, which puts it above $4,000 a month this year. Georgia will let you in with almost no income threshold at all. Some of these visas come with genuine local tax advantages. Croatia, for instance, exempts qualifying digital nomads from local income tax entirely.
Others simply keep you outside the local tax net as long as you stay under a certain number of days, typically the classic 183-day threshold that shows up again and again in international tax law, because it's the line most countries use to decide whether you've become a tax resident. A few more are worth knowing by name, because each one solves a different problem. Malaysia's program runs 2 income tracks, above roughly $24,000 a year for tech professionals, above $60,000 for everyone else, and gives you a modern English-friendly base in Kuala Lumpur at a fraction of what Singapore would cost. Thailand's long-term resident visa courts a different crowd entirely, high earners and retirees who want years of stability rather than a rolling 1-year renewal. Indonesia's Bali-focused program skips a monthly income test altogether and instead asks for a 6-figure bank deposit, which tells you exactly who they're trying to attract.
None of these programs are interchangeable, and the mistake I see most often is someone picking a country for the postcard and only checking the actual visa requirements after they've already told everyone they're moving. This is the layer that makes the strategy accessible instead of theoretical. You don't need $1 million sitting in a Cayman bank to start using jurisdictional structure. You need a remote income stream, a passport, and the willingness to actually understand the residency rules of wherever you land, instead of assuming a nice climate means a clean tax situation. Layer 3, and this is the one that trips up almost every American watching this video, is citizenship. Specifically, the fact that the United States is one of only 2 countries on Earth, alongside Eritrea, that taxes its citizens on their worldwide income, no matter where they live. Moving to Dubai doesn't end your relationship with the IRS if you're a U.S. citizen. You still file, you still report. If you just felt your stomach drop a little at that, hold on, because it gets better fast. This is where the foreign earned income exclusion becomes the single most underused tool in the entire American expat toolkit. For this tax year, a qualifying American living and working abroad can exclude up to $132,900 of foreign earned income from U.S. federal tax. A married couple who both qualify could potentially exclude close to $266,000 combined. Stack that against a rising standard deduction, and you get the scenario I opened this video with. A 6-figure earner living in a zero-tax country, filing a U.S. return every year exactly as required, and legitimately owing close to nothing to either government. 2 tests get you there. The bona fide residency test, genuine ongoing residency in a foreign country for a full tax year. The physical presence test, physically outside the United States for at least 330 of any 365 days. Miss that threshold and the exclusion evaporates. This is precise, calendar-driven law. It rewards people who track their location like a spreadsheet, and it punishes people who assume good intentions are enough. There's a 4th layer that doesn't get its own headline the way zero-tax country does, but it quietly does as much work as anything else in this strategy: territorial taxation. A handful of countries don't offer zero tax across the board. They simply refuse to tax income that was earned outside their borders. Panama is the classic example. Live in Panama, earn your money from clients in the United States or Europe or Asia, and Panama has no interest in taxing that foreign-sourced income, even though it will tax you normally on anything earned locally. Costa Rica runs on a similar principle. Malaysia has historically exempted most foreign-sourced income for individuals as well. Georgia, the country, not the state, goes further still, letting citizens of roughly 95 nations stay for a full year without a visa at all, which quietly accomplishes the same outcome as a dedicated nomad visa without the paperwork. Territorial systems matter because they widen the map considerably. You're no longer limited to the 16 or so countries with literally zero income tax on paper. You're now choosing from dozens of places that will simply leave your foreign income alone, provided you can prove, cleanly on paper, exactly where that income actually originated. Europe runs its own version of this same idea, and if you want a strong, walkable, culturally rich base instead of a beach retreat, this is where you'll actually end up looking. For over a decade, Portugal's non-habitual resident regime was the single most popular tool in this entire space. 10 years of a flat 20% rate on qualifying Portuguese income, plus a broad exemption on most foreign-sourced income, open to almost anyone willing to relocate. It attracted thousands of people. Then, in 2024, Portugal closed it to new applicants entirely. It's since been replaced by a narrower program people call NHR 2.0, officially IFICE, which keeps the same flat 20% rate and a similar foreign income exemption, but now restricts eligibility to specific high-value professionals in fields like scientific research, technology, and innovation, and requires a real qualifying credential to get in the door. Retirees and passive investors, exact people who used to flock to Portugal under the old rules, largely don't qualify anymore. Portugal isn't even the biggest example of this happening. The United Kingdom ran its non-domiciled tax status for over 200 years, letting foreign domiciled residents shield their foreign income and gains from UK tax as long as they didn't bring the money onshore. It ended in April 2025. completely, replaced by the much shorter 4-year exemption window for genuinely new arrivals, after which worldwide income and gains become fully taxable at standard UK rates. 2 centuries of continuity gone inside a single budget cycle. I'm telling you both of these stories not to scare you off Portugal or the UK specifically, but because together they're the cleanest illustration of a rule every architect eventually learns the hard way. These structures are not permanent fixtures of the landscape. They're policy decisions made by finance ministries responding to political and fiscal pressure, and they can close to new applicants or disappear entirely inside a single legislative session. Anyone who built their entire plan around one country's current year tax regime with no contingency at all learned a very expensive lesson in why diversification isn't just for an investment portfolio, it's for your entire structure. Which is exactly why the smart move isn't picking one country and stopping there. It's understanding the whole menu, because the menu keeps changing, and the person who only knows one dish goes hungry the day it's removed. Spain runs something called the Beckham Law, a flat 24% rate on Spanish employment income up to 600,000 euros a year, available to almost anyone who wasn't a Spanish tax resident in the prior decade for 6 years.
Greece currently offers qualifying foreign pensioners a flat 7% rate and separately runs a €100,000 flat annual charge for wealthy non-domiciled residents who'd rather pay one fixed number than a percentage. Italy runs something similar for high net worth individuals, a flat annual fee, now in the low 6 figures in euros, that covers all foreign-sourced income regardless of how much of it there is, which only makes sense once your foreign income is large enough that a flat fee beats a percentage. Cyprus offers a non-domicile status that exempts dividends and interest from its special defense contribution for 17 years, which matters enormously if your income is investment-driven rather than salary-driven. Malta runs a remittance basis system where non-domiciled residents are only taxed on foreign income they actually bring into the country, so a disciplined person can legally live well on money that never technically enters the Maltese tax net. And Bulgaria, quieter than all of them, simply runs a flat 10% rate on almost everything, with no upper limit and no narrow eligibility list, which is exactly why it's become the fallback a lot of former NHR applicants are now looking at. This is also where an older piece of offshore thinking, sometimes called the flag theory, still holds up remarkably well, even though the language around it has gotten dated. The core idea is simple. Don't concentrate your citizenship, your tax residency, your business registration, and your banking all in the same single country. Spread them deliberately. Your citizenship might sit with one nation, your tax residency might sit with a territorial or zero-tax jurisdiction. Your operating company might be registered somewhere with favorable corporate treatment and strong banking relationships. Your personal banking might sit in a fourth politically stable jurisdiction entirely separate from where you live day to day. Nobody who follows the old single-country model realizes how much risk they're carrying by having every single financial thread run through one government's rulebook. Architects deliberately cut that concentration risk into pieces so that no single country, no single election, no single policy shift can touch everything they've built at once. Let's make the citizenship flag concrete, because diversify your citizenship sounds abstract until you see the actual mechanism. Several Caribbean nations run formal citizenship by investment programs, and St. Kitts and Nevis runs the oldest and best known of them, offering a second passport in exchange for a government contribution that historically started in the low 6 figures, with no requirement that you ever set foot on the island to keep it. Antigua and Barbuda, Grenada, and Dominica run comparable programs at similar price points, each with its own visa-free travel mark attached to the resulting passport. This isn't the same tool as a digital nomad visa or a tax residency program. It doesn't reduce your tax bill by itself. What it does is give you a second, fully legitimate legal identity that isn't tied to your original government at all. A genuine fallback if your home country's policies, currency, or politics ever move in a direction you don't want to be trapped inside of. For a U.S. citizen specifically, a second citizenship obtained this way changes nothing about your U.S. tax obligations on its own. You're still a U.S. citizen unless you formally renounce, but it does mean that fallback already exists, built before you'd ever need it, instead of something you'd have to scramble for under pressure.
These programs have also gotten more rigorous over the past few years, not less. Every serious Caribbean program now runs multi-layered due diligence checks against international databases before approving anyone, which is exactly why the passports that come out the other side still carry real visa-free access. A program with no vetting is a program the rest of the world eventually stops trusting, and that trust is the entire value of the passport. One caution belongs right here because skipping it would do a disservice to every entrepreneur watching. If you're a U.S. citizen and you register a foreign company to route your income through, the IRS doesn't simply let that income sit offshore untouched. Rules around what the tax code calls a controlled foreign corporation, paired with a regime called GILTI, Global Intangible Low-Taxed Income, exist specifically to reach into a foreign company you control and tax you personally on a share of its profits, whether or not you ever pay yourself a dividend. That doesn't make the corporate layer useless. It means it has to be built by someone who understands these specific rules, not copied from a blog post written for someone holding a different passport than yours. Non-U.S. citizens routing income through a company in a zero-tax jurisdiction face a genuinely simpler version of this problem, since most of them aren't taxed on worldwide corporate profits the way Americans are by default. That asymmetry is one of the more overlooked advantages that comes with a second citizenship, and it's exactly why citizenship diversification keeps showing up on serious family office checklists, not just residency diversification. There's a fifth flag almost nobody brings up in these conversations because it's the one people are most afraid to say out loud: giving up U.S. citizenship entirely. I'm not recommending this, and for the overwhelming majority of people watching, it wouldn't make sense. But understanding this strategy completely means understanding what actually sits at the far end of it, because a small and growing number of high net worth Americans do eventually take this step, and the mechanics are precise enough that you should know them even if you never use them. The administrative side has even gotten cheaper recently. The State Department cut the renunciation filing fee from $23.50 down to $450 in 2026. That fee reduction changes nothing about the tax mechanics, only the paperwork cost of the decision itself. The IRS doesn't just let you walk away quietly. If you renounce and you're classified as a covered expatriate, you trigger what's called the exit tax, and you become one if you meet even one of three tests. A net worth test: your worldwide net worth, everything you own minus your debts, is $2 million. A tax liability test: your average annual tax bill over the past 5 years before you leave exceeds a threshold sitting at $211,000 this year. A compliance test: you fail to certify under penalty of perjury that you filed clean U.S. returns for the 5 years before you go. Trip any single one of those three tests, and you're a covered expatriate, whether or not you meant to be. Here's what actually happens if you are one. The IRS treats you as if you sold every asset you own worldwide at fair market value on the day before you expatriate, even though nothing was actually sold. Whatever gain that deemed sale produces gets taxed, but there's a real exclusion. The first $910,000 of that gain this year is excluded entirely. If your total unrealized gain across everything you own comes in under that number, you can technically be a covered expatriate, file the required paperwork, and still owe nothing at all.
Only the gain above that threshold actually gets taxed at ordinary capital gains rates. Retirement accounts get treated differently again, generally deemed fully distributed the day before you leave and taxed as ordinary income, which is a very different animal from the capital gains treatment everything else receives. Notice what this actually tells you. The exit tax isn't a punishment for leaving. It's a mechanism that closes out deferred gains the government was always eventually going to tax before you move somewhere it can't reach them anymore. Most Americans who renounce every year never cross these thresholds and never owe a cent of it. They just complete the paperwork. It's specifically the people whose net worth or income already puts them deep into the zero tax and territorial strategies we've spent this video on, who eventually have to sit down and run this exact calculation before deciding whether the final flag is worth planting at all. Notice what's happening across all 5 flags. This isn't one trick. It's a structure, built the way an actual building is built. A jurisdictional foundation, a residency framework layered on top of it, a citizenship and compliance layer that determines what you still owe back home, and for the small number of people who ever need it, a final exit layer that closes the whole structure out cleanly. Followers look for a single loophole and get disappointed when it doesn't fully solve their situation. Architects understand that no single flag does all the work. The flags do the work together. I want to be direct with you about something because I'd rather you hear it from me than learn it the expensive way. None of what I've just described is a suggestion to hide money, misreport income, or quietly disappear from a tax system you still legally belong to. Every strategy in this video is built on public law, filed disclosures, and legitimate residency. The difference between tax architecture and tax evasion is documentation, and it is not a small difference. It's the entire difference. I'm not a lawyer and I'm not your accountant, and nothing in this video is personalized legal or financial advice. If any part of this resonates with your situation, the next call you make isn't to book a flight, it's to a cross-border tax attorney who can model your specific numbers, your specific citizenship, and your specific income type before you move a single dollar or a single day of residency. One more piece of this needs to be said plainly because it's the reason that documentation point isn't optional or old-fashioned. The era of quietly hiding an account offshore is functionally over. More than 100 countries now automatically share account balance information with each other every year under a system called the Common Reporting Standard, and the United States runs its own parallel version specifically aimed at its own citizens called FATCA, the Foreign Account Tax Compliance Act, which requires foreign banks to report accounts held by U.S. persons back to the IRS or face steep penalties themselves. On top of that, any U.S. person with foreign financial accounts totaling more than $10,000 at any point in the year has a separate personal obligation to file an FBAR directly with the Treasury Department, regardless of what the bank itself reports. Practically speaking, this means that if you're a U.S. citizen and you open a bank account in the UAE, Portugal, or anywhere else, your own government very likely already knows that account exists automatically without you telling them, and you still owe your own filing on top of it. This is exactly why everything in this video is built around disclosed structure rather than concealment. Concealment was never actually available to begin with, not anymore. Documented legal structure is not the cautious option here. It's the only option that was ever real. There are trade-offs baked into every option I've described, and I'd be doing you a disservice and honestly doing the whole idea of financial architecture a disservice if I only showed you the upside. Zero-tax countries with the highest livability, Monaco, the UAE, tend to come with a genuinely high cost of living once you factor in housing and daily expenses. Countries that are cheaper to access, some of the Caribbean nations, some of the more remote Pacific options, often trade lower cost for thinner infrastructure, less advanced healthcare, less developed education systems, more limited air connectivity. And nearly every digital nomad visa requires you to actually establish real ties, a lease, a bank account, sometimes a local phone number, sometimes proof you're not just island hopping on paper while your accountant tells the IRS you live somewhere you've never actually slept. There's also a quieter risk that catches people who move fast and read slowly. It's entirely possible to accidentally trigger tax residency in 2 countries at once because each country runs its own version of the day count rule, and they don't always line up neatly against each other. Tax treaties exist specifically to resolve that overlap, but only if you actually check which treaty applies to your specific pair of countries before you move, not after. This is the part that separates people who watch this video and do nothing at all from people who watch this video and actually build something. The information is not scarce anymore. 16 zero-tax countries, 60-plus nomad visa programs, a published indexed foreign earned income exclusion number that updates every single year. None of this is hidden. What's scarce is the willingness to treat your tax residency as a designed variable instead of an inherited accident. Most people will finish this video, feel a flicker of possibility, and go back to renewing the same lease in the same city under the same tax bracket they've had for a decade. A small number of you are going to open a new tab right now and start comparing digital nomad visa requirements against your actual income. That's the only difference between the two groups. Not luck, not birthright, direction. Not more capital, not a better passport, not a lucky break. Just the decision to actually open the map instead of memorizing someone else's. That's why we keep coming back to the same idea on this channel, the one I opened with, because it's not a slogan, it's a filter you can run every decision through. We don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. A moat isn't built by accident. Nobody wakes up one morning with a structural advantage already in place. It gets designed, plank by plank, jurisdiction by jurisdiction, filing by filing, by people who decided their financial geography was theirs to draw. Before you go, I want to actually hear from you, because this is exactly the kind of decision where there's no single right answer, only trade-offs that hit different people differently. The billionaire nomad path isn't just for the ultra-wealthy anymore. But everyone reading this video has a different deal breaker. Some of you would take the flat, no-tax simplicity of the UAE in a heartbeat. Others would never trade a slower, cheaper life in Portugal or Georgia for a Dubai high-rise, no matter what the spreadsheet says. So tell me honestly, right now, in your own words,
If you could legally restructure your tax residency starting tomorrow with zero risk and zero paperwork friction, what's the first country you'd actually move to? And what's the one thing holding you back from doing it in real life? Put it in the comments below. I read every single one, and the disagreements down there usually teach me more than the agreements do. Hit subscribe. Next time on this channel, we're going to take this exact structure and run it forward 10, 20, 30 years into the future, because choosing the right country is only half the blueprint. The other half is what happens when you try to pass everything you've built across a border, across a currency, and across a generation without a foreign government or a probate court taking a cut you never agreed to. That's estate architecture, and most people don't think about it until it's far too late to design it properly. I'll see you right there. Until then, keep building the moat.